Well, hi traders, Chris Weston here, Head of Research at Pepperstone. I want to talk to you today about one of the big talking points in the financial markets, which of course is this idea of a liquidity drain, which is impending. The idea the Treasury Department in the US are going to issue such a large amount of supply to the market under T-bills that we're going to see liquidity being sucked out of the private sector, and it's going to cause headwinds to a loved equity market. We could see the US dollar going on a bit of a run, and ultimately it may cause higher volatility across markets. Now, it may not. This may be a complete hype story, a bit of a nothing burger in a fairly sanguine market, or it may be something that causes ripples across financial markets. We don't know. But I think one of the great things about TradingView is that we can use the watch lists, and we can create watch lists using a whole range of instruments to monitor the situation real time and look at the market is showing a greater concern and reacting to this. And we're starting to work as a herd. And obviously then that could be very important, not just for entering to trades and working on a tactical basis, but also managing our risk in a far more heightened situation. Now, I will say that what a lot of this is coming at a time when European banks as well are going to be asked to repay 530 billion euros of legacy PEP loans, and the remaining balance needs to be paid back to the ECB, and that may cause concerns around bank funding and also liquidity coming off the bank's balance sheet. We'll have to see how that sort of plays in. I don't think that's necessarily fully priced in, but obviously going back to the focus with the US. Now, let's take a step back. We've just seen the US Congress vote through a 2-year extension for the debt ceiling. It's unlimited. And that means that the US Treasury Department are now going to be able to go and rebuild its cash levels from very low levels indeed. One of the first things we look at is the Treasury General Account. The Treasury Department, like anywhere else, has to hold cash with someone, and they hold it with the Federal Reserve. It's called the Treasury General Account. It's effectively their checking account. It's an asset for the Treasury Department, but it's obviously a liability for the Federal Reserve. One of 3 big liabilities that the Federal Reserve has. One, of course, is the RRP balances, and the other one is interest on reserve balances as well. But right now we're looking at the Treasury General Account, which needs to be rebuilt very aggressively, very quickly coming through. In fact, we're going to see that coming through over the next few days, with the Treasury Department issuing 170 billion of short-term bills to the private sector. Now, Treasury bills are the instrument of choice here. That's typically what they use. These are short-term debt instruments with a maturity of 1 month up to 12 months. They don't pay a coupon, but they are issued at a discount and redeem at 100 or par. These are very, very important instruments for the financial system. They're used in repo, for collateral. They're used for cash management purposes across all types of businesses. Yeah, they're the highest quality assets in the financial system. And this is generally what we're going to be seeing issued to market with different maturities playing through. But ultimately, the Treasury Department have said that they want to rebuild the Treasury General Account, or the TGA, to about 600 billion US dollars by the end of September. That's what they said in the May refunding. So you can see here on TradingView under the ticker WDTGAL that this has obviously come under pressure. That actually sits now at $20.89 billion. This actually has a 1-day lagging indicator. So we're down about here at the moment. Now, yeah, this is a point now where we're going to see this being rebuilt very aggressively. This is the Treasury General Account. Now, if we include other factors that need to be paid for by September, things like Medicare, Medicaid, Social Security, other bond obligations that need to be paid for, we would expect the Treasury Department on a net basis to issue around 850 billion US dollars of T-bills by the end of September. Now, that's obviously a significant amount of supply that needs to be taken down by the market. So the first port of call we need to ask is, will there be a valuation shock? Will there be so much supply coming to the market that people are going to be demanding high yields for T-bills? And the talk on the traps from primary dealers is that this should be quite easily absorbed by the private sector, and it shouldn't cause too many gyrations in short-term rates playing through. So that's one factor. That's a big positive, I guess, for risk assets in that sense. But we are going to be seeing 850 billion being asked to be taken down in short space of time. So that begs the question, who is going to be buying it? And regardless, who buys this could have big implications for the financial system. So on one hand, we have reserve balances, effectively RRP. Now, to sort of go back to where we were through the recent crisis of the banking situation, is a lot of money came out of banks' balance sheets and went into into money market funds. We can see that $5.2 trillion sits in money market funds. It's still rising at the moment, but that pace is obviously is slowing down somewhat. Now, money market funds will be big investors in the Fed's RRP facility. You can see at the moment there's $2.14 trillion. You can see this here on TradingView under RRP ONTSYD. Now, this is really important. We're looking at and we're monitoring this level on a weekly basis. This comes out on a Thursday for us, but this is reported every Wednesday. So we're looking at the level of capital that's in the RRP facility. Now, what's interesting is money market funds will put this money in the RRP facility. You can see currently there's $2.14 trillion. And what they'll get is 5.05% risk-free. That's very attractive. These money market funds are getting 5.05% risk-free. Now, are these money market funds going to liquidate or withdraw, some of this $2.14 trillion and redeploy that into Treasury bills? Now, tactically, it doesn't feel like there's a high probability for that to happen. You may see some coming through, but initially, it doesn't really make a lot of sense. So the Federal Reserve are still expected to raise rates if we look at the rates curve. And if you were to buy a Treasury bill, the yield on offer is reasonably attractive. You can see yields on 1 month, 3 month, and currently above that RRP facility rate. But the concern that you would have if they were to lift rates and it's not fully priced in is that you would get a capital loss on that position. The yields would move up, prices would go down. Now, in that situation, if rates were going up, why would you not want to be in the RRP facility? Because effectively that would go up by 25 basis points potentially, and you're still getting that without any kind of capital issue coming through. So a lot of these banks will be sitting there, a lot of these money market funds will be sitting there in the RRP facility earning 5.05%, knowing that if the Fed were to raise rates, they're going to get a better return. And they're doing this risk-free without any kind of capital position. So it doesn't feel like that you're going to see a lot of liquidations out of the RRP facility to take and support these Treasury issuance. Now, if we were to see the RRP facility being used, that's a positive for risk assets. A lot of this money has already come out of the financial system, out of the banking space, and is now sitting on the Fed's balance sheet, earning 5.05%. And if we were to see that money being withdrawn, it's not going to be a liquidity withdrawal from markets. Where we are concerned, and where the market is a bit more concerned, if we were to see reserves being taken down, bank reserves being taken down from the financial system, support this 850 billion of issuance coming through. Now, if we have a look at how this works out, we can see that there is $3.2 trillion worth of reserves in the system. Now, that to understand this a little bit better, when a bank receives a deposit, let's say $1 million, they are expected to hold a certain percentage of it against that deposit as a reserve. So at the moment, it's about 10% is the reserve ratio requirement. So if you receive $1 million for a deposit, you have to hold $100,000 as a reserve against that. There is a minimum level of regulatory reserves that you need in the system, and anything above that level can be used to find a return. These are excess reserves in the financial system. So we can go onto TradingView and we can have a look at IORB, interest on reserve balances. And effectively on these excess reserves that they have over their regulatory requirement, they can earn 5.15%. Now, if we were to look at this in a holistic perspective, this is really important because this is the channeling of the financial system. This is how it works. The Federal Reserve will channel money by working it within a corridor of interest earned on reserve balances and RRP, which we can see is this blue line and this red line. And you can see the difference is about 10 basis points at the moment. And really, the Fed funds effective rate, which is the cost for banks to borrow overnight, currently sits at 5.08%. And that moves in this channel between the two. You can see at the moment it's currently sitting around the lower echelons because liquidity is still abundant, reserves are quite fine, high in the system, but that's where we are at the moment. This is really important. This is how the Federal Reserve guides the cost of money. Every time that they raise by 25 basis points, they lift both the interest on reserve balances and also the RRP, and then you'll see that the cost for overnight liquidity, such as like GC repo rates and so forth, and all these kind of things, will trade as a weighted average between these two rates. And that's really how they move the cost of money on an ongoing basis. So really, when you're looking at these excess reserve balances, we can currently see under the ticker here, WRB, WFR, BL, the level of excess reserves that are in the financial system, which we can see at the moment is $3.2 billion. Now, we also need to remember that Fed quantitative tightening is taking place in the background. And over the next 4 months, we expect that balance sheets and reserves to come down to by about $300 billion as well. Now, of course, that's where we're going to see the US Treasuries up to 95 billion, or US Treasuries and mortgage-backed securities up to 95 billion, hitting that cap, and effectively they will roll off the balance sheet every month. Now, if we think to ourselves that we're going to have very low participation from RRP balances, then it's really going to be bank reserves that are going to need to be taken down to support this bill issuance. So in effect, we are thinking that probably bank reserves and these excess reserves could fall to about 3 trillion by the next month. And by the time we fully absorb these 850 billion, we could get down to about $2.5 trillion. Now, that's a big drain on reserves coming out of the bank reserves coming out of the financial system. Now, the interesting thing is there's what they call the lowest comfortable level of reserves in the financial system, which is equating to about $2.1 trillion. And the way they kind of calculate that loosely is really they want it to be a certain level of US GDP, about 8% of GDP. GDP is around $23 trillion at the moment. So they say that there should be around about $2.1 trillion of reserves in the financial system. Now, if bank reserves are coming down, there could be an impact on the banks. And that's something that we are going to be watching. Of course, if reserves are coming down, deposits need to come down as well. And if we're going to see deposits coming down at a time when RRP balances are still very high, what they can achieve in the RRP is very attractive. It could cause concerns around credit and a contraction in credit again as bank deposits are coming down. People are fighting for deposits. It could see bank funding costs going up. We could see deposit betas moving higher. And again, we could be starting to look at the KRE and the BKX and all the banks and saying to ourselves, what's going to happen with the cost of capital or banks lending coming down? And of course, if we see reserve balances coming down sharply and deposits are falling out of the banking system, we're back to this situation again. We're very concerned around what's happening there as well. But the other factor is when we get to a reserve scarcity. And I think this is a really important point. As we get down to that lower comfortable level of reserves, it could have an impact on dollar funding rates. And this is what I look for on TradingView. If we have a look at the difference between interest on reserve balances and RRP, we can see that effective funds rate. I'm using this as a guide for scarcity. When people say there's too few reserves in the financial system, we're getting to that lower echelons. What you will see is the Fed funds effective rate moving higher, overnight funding, overnight cost of funding, and these things like GC repo rates are going to be moving higher as people pay up for those overnight funding, overnight rates coming through. Now, if it was to hit to the top of the channel, I think that would start to send waves of concern around the markets. If we were to break through this end, so it's an inelastic kind of situation where people are not concerned about the level, they just want that overnight liquidity, and they're prepared to pay whatever. If it was to break through the top end of this and potentially trade 10, 20 basis points like we saw in 2019, then I think two things are going to happen. Either we're going to see the Fed looking to do stuff with repo, make repo balances repo less attractive and cause money to come out there and try and support the repo market. Or you're going to see potentially people talking about a short bout of reserves coming to the market, i.e. quantitative easing playing through. So this is a really important situation. When those reserve balances fall, as reserves are used to take this Treasury bill issuance up, if we see the effective rate move up into the top end of the corridor, I think that could have big implications for financial markets. So that's, again, something I am watching very closely. I don't know if it's definitely going to happen, but that is a trigger point that I'm using within TradingView as well. So again, we're watching what's happening we're watching what happens with reserve balances. How much lower are they going to go? We're watching what happens with repo. How much lower are they going to go? That will tell us who's taking these up, who's taking up the absorption of the Treasury issuance. If it's RRP, it's not too much of a concern. If it's all reserve liabilities being withdrawn, the market could respond quite negatively to that after a period of time. And again, we're watching what happens with banks and deposit outflows, and we're also watching what happens with the effective funds rate and whether it can move up into the top end of that corridor. If it does, people might start talking about scarcity. Of course, this might be a nothing burger, but these are the signs we're looking at. Good luck.